Now, we are the guy on the left, calm, cool, collected, not in a hurry, no rush. 99% of people are the guy on the right. They chase narratives. They can't hold a stock. They panic. They check the portfolio every day. Oh, it's in the red. It's in the green. It's in the red. Panic. They fundamentally don't understand what they're invested in. They don't understand why stocks go up. They don't understand corporate finance. That's 99% of investors. My opinion, to be truly successful, you got to do the opposite of most people. Most people want fast money, fast and fragile. They're always in a hurry and they want a silver bullet to fix all their problems. I see it all the time, especially when I see new people come onto this channel and they think, oh, I've discovered some new sort of secret, this whole family office structure, buy, borrow, die strategies. And I can always tell straight away they think it's like a quick fix. And nothing is a quick fix. And I know most of these people are just not going to like the answer. The answer is patience, steadfast, a slow accumulation. But most people don't want to do that. And honestly, if you take your time, you're more patient and you're not in a hurry, and you just build your portfolio brick by brick, slowly at a time. The same with your own life, career, business, whatever it is. All the most successful people, they were not in a hurry. They were long-term thinkers. I'm already thinking about the investments for 2030 and in the next 10 years. But this is what you're up against. This is the retail world. And they always say the exact same excuses when I say we buy and hold a stock and we never sell the stock. It's always the same. I can almost tell you straight away what they say. Well, the stock market 50 years ago, the top 10 companies are not the same as the top 10 companies today. So all companies die off. All big companies are all the same. Just big companies in the past are the same as big companies today. So they use this as an excuse. This is like an intellectual deflection. Well, I can't buy Google and Apple or whoever because they're not going to be around in 50 years. I don't know if they're going to be around in 50 years. So no, I'm not going to buy it. So suddenly they're now a long-term investor. Suddenly they're thinking 50 years ahead. But really it's just a get-out-of-jail-free card. Of course, no one can say what companies are going to be around in 50 years. But I'm not asking you to just buy a stock and blindfold yourself. That's not what I'm saying. I'm saying, can you hold it for a 12-month rolling contract? An annual review? Is the financials still good? Is the company still growing its owner's earnings? Does the company still have pricing power? But most investors can't even hold it quarter to quarter. One piece of bad news, they'll dump the stock. They need to take some sort of action. These are the people that have the same excuses. Oh, the stock market's all rigged and it's gambling and it's this and it's that. They're just not educated. The wealth gap is a knowledge gap. I will say that every single time. When you really understand what I'm trying to push across on the channel, when it really clicks, you'll start to realise the beauty of corporate finance. Let's look at an example where you invest and you go down with the ship. Let's say you buy a stock, 10k, to a company growing 18% annually. And I know straight away, how dare you say 18% compounded annual growth rate? That is blasphemy in the world of finance. How dare you say such things? But I'm not saying the company doesn't need to grow 18% revenue every single year. That's not how it works. It just needs to grow free cash flow per share 18%. Now, the companies that can do this are automatically companies that have pricing power, that have a monopoly, that have some sort of moat. Even if you held this stock, 10k, and you just went down, like just completely stubborn, yeah. You didn't even sell it. You just held it. And it grew to 600k after 25 years. And the company lost its position, it's lost its pricing power. Because you have such a margin of safety, the margin of safety, it was so high because of you had a good entry, a fair entry valuation. You're still up. This investor would still be up, 1,700%. We don't need the company to grow forever. Even if it grows and then stagnates years later, you can still make money. Keep in mind, this company is still paying dividends. And especially if the company's winding down, it will be paying out dividends even more. 100%. So this investor in this example, even though the drawdown percentage was like 70%, they still made a massive net profit. Now that's assuming they just brutally stubborn. Company lost its pricing power. 5 years go by, the owner's earnings is declining. They still didn't sell the stock. Yeah, that's not what I'm telling you to do. Yeah, if the company's lost pricing power and owner's earnings are a stagnation and decline, yes, you would sell the stock. Of course, it's not a blood pack. As for people saying 18% is impossible, companies do it all the time. But people just look at a stock ticker. They look at a stock ticker and that's it. They don't look at a company, they don't look at financials, they don't know any of that. What I'm saying is, if the company's growing free cash flow per share, earnings per share at that growth rate, the market will eventually catch up and reward it. No doubt about it. It's physics, it's financial physics. This is how the game is played. Companies have done it time and time again. Apple's a fantastic example. Its revenue can stagnate, but it has ways that it can increase its free cash flow per share. It's notorious for buybacks, and it can bully suppliers. Doesn't necessarily pass the price hikes onto customers because it's a B2C. It doesn't have that pricing power to us as consumers, but it does have pricing power against the suppliers. Apple's notorious for pulling down its cost of goods. So it has ways in which it can adjust to reach that compounded growth of like 12% plus its dividend. Companies can do it all the time. Look at, for example, S&P. This is a good example because a retail investor would look at this and say, look, it's down 12%. This is dead money. We're going to dump this stock because it's dead money. The situation with Standard & Poor's is it was very overvalued at one point. People paid like 40 times free cash flow back in 2021. But it's starting to sort of catch up. It's grew its free cash flow per share by 31% over the last 3 years. That's another example of like a coiled spring. Yeah. But for new entries, people trying to buy that stock now, they're paying a higher valuation. So your entry valuation is so important. That's so important. And if you don't know what you're doing with entry valuations, you don't necessarily need to. I'll be posting valuations of ETFs and big companies on my newsletter. Please, if you haven't subscribe to that. And I'll distribute valuations of companies if they're undervalued and they are monopolies with pricing power that can compound. I will notify you. I'm not going to spam you. Yeah, I'm just going to maybe send out email maybe once or twice a week. And I'll also put my spreadsheets in there as well. But this is why people can't buy and hold. They hide behind excuses and they don't have the financial knowledge. If you understand more of this, you will become a better investor. And the ROI is infinite. The ROI is infinite. Think about it. If you're avoiding paying taxes, capital gains tax from selling a stock, if you're not wasting opportunity cost and you're allowing your winners to keep on winning, this is fundamental investing. It's nothing secret, nothing new. This is just typical value investing. The Peter Lynch's, the Warren Buffett's, this is the philosophy they always taught. And people just want to throw excuses. They want to throw excuses, and they do it all the time. Doesn't matter what I say, they go, but Warren Buffett, he sold Apple. Yeah, and he shouldn't have. He's also sold Costco, and he shouldn't have. He's made plenty of mistakes himself. People treat him like he's God. These super investors are human just like me and you. Yeah, but if they can hold a stock forever, they will do it. That's what they say. They all believe the same philosophy. You're not going to sell a company, and if you have to sell it, it needs to be a last resort, absolute last resort. So you go. 99% of people cannot do this. But if you can, I mean, most importantly, what is your excuse to sell an ETF then? Fine, understand single companies. What about an ETF? Why would you sell an ETF? Give me one valid reason. I mean, unless it crashes like 90%, what ETF are you buying that's crashing 90%? What was your entry valuation? This is what I'm saying. People are so afraid of stocks crashing like 80% plus, but that's only going to happen if you paid a stupid valuation, like dot-com bubble valuation, with companies with no earnings. I'm telling you to look at these companies like if there was a private business. If there was a private businesses and they were growing their earnings, you would be delighted. But suddenly, because it's a public equity and the stock market can get scared, suddenly that changes everything. But if you own these as private companies, you'd be delighted. That's what I'm trying to break through to people. And all the super investors said the same thing, like Berkshire Hathaway in his annual shareholder meeting. They said this for like their whole life, and people still didn't get it. So I'm like, if they couldn't do it, what chance have I got? But I'm like, maybe I can take a stab at it. So there you have it. Please subscribe to the newsletter. I'm working on a little website on it. I'm going to put my spreadsheets on there, and if you get one piece of valuable information on there, the ROI, thousands of %. Without question.